Good day, everyone. So today is our week 8 or the last week of our discussion for first quarter with the subject business finance. So now we are going to discuss our last topic for this quarter, and our topic for today is all about long-term financing. So those long-term financing is we have the sources and costs. So before we discuss more about the topic today, let me first read to you the objectives. So at the end of this chapter, the students should be able to A. Discuss long-term financing, B. Identify the sources of long-term funds, and C. Describe the costs of long-term funds as a source of financing. So, long-term financing concept. So the source of funds is considered the long term when the repayment period is more than 1 year, notwithstanding the normal operating cycle of the business. So when you say long term, this connotes a term of 5 years or more. So a term of more than 1 year but less than 5 years is referred to us as a medium term. Alright. So next is that to finance the acquisition, construction, or purchase of fixed assets, businesses commonly derive the funding requirements from long-term sources as illustrated in the figure that I will show you on the next slides. Alright, so here it is. So the finance acquisition, so construction or purchase of fixed assets. So the businesses commonly derive the funding requirements from long-term sources as illustrated in the figure that I am showing you now. So this is a fund sources of asset requirements. So the total assets of the business, um, under it is the current assets, wherein the current assets are the working capital and also the fixed assets. So when you say current assets or the working capital, this is financed by short-term funds. And for when you say fixed assets, these are financed by long-term funds. So the relationship between the assets and the sources of financing appears as the formula assets is equal to liabilities plus the capital. So the liabilities and the capital, it is located on the right hand side of the equation, are considered the sources of funds to finance the requirements of assets. So the assets located on the left side of the equation are the applications of the funds. So since assets are broadly divided into current and fixed, while the liabilities are divided into current and long term. So the expanded equation appears as like this. So for the current assets plus the fixed assets is equal to the current liabilities plus the long-term liabilities plus the capital. So since current liabilities primarily provide the funding requirements of current assets or the working capital, the long-term liabilities and capital supply the much so needed funds of fixed assets requirements. So in finance, the mixture or sum of the current assets and the fixed assets is what we call the financial structure. So on the other hand, the mixture of long-term liabilities and capital is called the capital structure. So again, when you say this, the sum of the current assets and the fixed assets, those are the financial structure. And when you say the long-term liabilities and the capital, this is what we call the capital structure. So in equation form, the relationships among assets, liabilities, and capital appear as, for example, we have here, so financial structure is equal to current assets plus fixed assets, while the capital structure is equal to long-term liabilities plus the capital. Or capital structure is equal to financial structure minus the current liabilities. Alright, so capital structure. So what is capital structure? So when a business is in need of a long-term funds to finance its fixed assets, its capital structure or primarily affected. So the equation of the capital structure shown in the preceding subsection indicates that the long-term funds may be sourced from the following. First one is we have the solely from long-term creditors. Second is we have the solely from the owners of stock or stockholders. And then we have the both from long-term creditors and owners. So here, we have here the formula for that. So we might say that capital structure is equal to the long-term liabilities plus capital. All right. So now, for example, if the we have here an example. So if the total capital structure of the business is 50 million pesos and the amount provided by the long-term creditors is 10 million pesos, then the stockholders who are the owners of corporation supply the funds of 40 million. So this kind of relationship between the creditors and the shareholders is grounded in the so-called trust fund doctrine. So, when you say trust fund doctrine, this requires that the funds provided by the stockholders protect the interest of the creditors. So, if the funds provided by long-term creditors are more than what have been provided by the shareholders, the business is adopting financial leverage in its capital structure. So when you say financial leverage, this means that the business has more funds like yung sa bonds and long-term bank borrowings coming from the long-term creditors in the capital structure. So for example, a capital structure is considered financial leverage when the long-term creditors provided 25 million pesos in equity while the shareholders finance only 10 million pesos in a 35 million capital structure. So meaning, we can call it financial leverage if the creditor or the long-term creditor provided the biggest amount than the shareholder. All right. Next, a company that does not finance its operation using long-term debt has a debt-free or unlevered capital structure. So a debt-free capital structure indicates that the owners provide almost all financial requirements of the business. So both the working capital needs and fixed assets requirements. So next is we have the factors influencing capital structure decision. So in the process of determining the most appropriate capital structure to be adopted, so we have here the following factors to be considered. First one is the business risk. So business risk, this refers to the amount of risk that is inherent in the operation of the business. It cannot be removed or detached from any business operation. Okay? The second one is so we have also the level or degree of risk that may be experienced by the business. So this is highly influenced by the following factors. So first, we have the demand variability. This is one of the business risks. So when you say demand variability, when the demand of the product is almost constant, the business risk is expectedly low. Second is we have the sales price variability. So the business is expected to experience high business risk when the sales price of the product is highly volatile. Next is we have the cost variability. So the high cost of producing an item offers more business risks and the ability to adjust sale prices for changes in cost. This is a business that has the ability to change the price immediately. So once cost decrease has low business risk. And then we also have the level of operating leverage. So a business that operates with a high operating leverage, even if there is a decrease in expected demand, they will also experience the high business risk. And then also the term operating leverage. Okay, so when you say operating leverage, this refers to the extent to which the business was fixed in its operation, under the operation. So next we have here the firm's tax position. So the firm may source the funds for fixed asset requirements from long-term liabilities like we have the bonds or the long-term bank borrowings. Third, we have the financial flexibility. So this financial flexibility refers to the ability of the business to raise long-term funds when needed. And then we also have managerial inclination. So managers have different perspectives on what capital structure to maintain. So those who are considered aggressive or those who are risk takers, they prefer to use the long-term debt to finance the long-term needs of financial structure of the business. Next is we are going to have the sources of long-term funds. So what are those sources? So the business may source its long-term funds to finance the acquisition or construction of fixed or non-current assets like building processing or manufacturing plant or machinery from the following. Okay, so we have here the first one is the long-term debt. So this may be in the form of long-term bank borrowings or bonds. So first one is we have the bank borrowing. So this is considered long-term when the repayment period is more than 1 year. Again, this is considered long-term when the repayment period is more than 1 year. However, long-term in this book covers a period of 5 years or more. Okay, you can consider long-term if it is 5 years or more. So, we also have the bond. So, bond is an unconditional promise to pay a specified sum of money at a determinable future time with a periodic interest based on the stated interest. So, the agreement is evidenced by a certificate called the bond indenture. So, the certificate is what we call the bond indenture. So, this serves as a contract between the issuing corporation and the holder of the bond, which is what we call the bond holder. Alright, so if the bond is issued at more than its face value, the difference between the issue price and the face value is what we call the bond premium. So on the other hand, if the bond is issued below its face value, the difference between the issue price and the face value is called the bond discount. Second is we have the preference share or preferred share. So this is a share of stock in which the holder enjoys higher preferences or rights over the holder of an ordinary share. So the holder of a preference share has preferences in the terms or in terms of the following. So we have the dividends, the assets. So those are the under it. So next is the ordinary share. So this is also called as common share. So this is a share of stock which does not enjoy any right or preference in the dividend and assets of the corporation. So if the corporation is authorized to issue only one type of share, so the corporation will automatically issue ordinary or common shares. So next one or the fourth one is we have the retained earnings. So these are the accumulated profits, losses, and adjustments of a corporation. So we only a corporate entity maintains retained earnings in the books of accounts. Next is we have the costs of long-term funds. First one is we have the capital budgeting. So this refers to the process of determining whether or not to commit a significant amount of long-term funds to projects whose usefulness is spread over several periods. So the minimum rate of return should at least be equal to the average rate of return so that the business may earn from alternative investment projects. So this average minimum rate of return is called cost of capital. So, cost of long-term debt. So, the cost of long-term borrowings or the cost of the bond as the source of long-term funds is computed as follows. So, here is the formula. Cost of debt is equal to interest rate times the quantity of 1 minus tax rate. So, for example, we have here the Board of Directors of Jenny Corporation has approved the construction of a processing plant at Pigkawayan for a total cost of 200 million pesos by issuing 10%. So 1,000 pesos bonds with a maturity period of 8 years. So the company is subject to an income tax rate of 30%. So what you're going to do, the required here is you have to compute the cost of the bonds. So how are you going to solve? So the cost of the bonds is computed as follows. So the formula, we are going to use the cost of debt. So you are going to get first the interest rate. So the interest rate on the problem is 10%. Okay. So next is our tax rate given on the problem is 30%. So just simply 10% times the answer for 1 minus 30%, that's 0.70. So 10% of 7.70 is 0.7 or 7%. Alright, so that is for the cost of debt. Next is for the cost of preference shares. So the formula to compute the cost of capital in case the business has opted to finance the acquisition of non-current assets through the issuance of the preference shares is cost of preference share is equal to dividends per share and then market value per preference share. So we have here example for this problem. So we have Yvonne Corporation plans to construct a 15 million pesos building to house its mechanical equipment. So Yvonne has total issued and outstanding 200,000 pesos, 10% preference shares with a par value of 100 pesos. So additional data are as follows. So we also have that current market price per preference share is 25 pesos and the dividend per preference shares is 4 pesos. So Yvonne is subject to an income tax rate of 30%. So if it is considering the issuance of preference share to finance the construction of the building. So now the required here is you have to compute the cost of preference share. So how we are going to use the given formula, and then we have to identify which is our dividends per share. So our dividends per share is 4 pesos and our market value preference or per preference share is 25 pesos. We are just going to simply divide it so that we can get the cost of preference share, which is 16%. Next is we have the cost of ordinary shares and retained earnings. So those are the cost of issuing ordinary shares to finance long-term projects or investments is computed as follows. So for stock price base, so when dividend growth rate is available, so that is the formula. And for the book value base, when dividend growth rate is not available, that will be the formula. So the same, we have here the problem. So Nicanor Incorporated has outstanding 300,000 ordinary shares. So par value is 100 pesos. So the current price of the ordinary share is 130 pesos and the dividend per share amount to 3 pesos. So Nicanor experiencing a growth rate and is subject to a 30% income tax rate. So based on the problem, so the the dividend growth rate is available. So we are going to use the stock price formula for that. All right. Next here, for the problem, we have the weighted cost of capital. So the weighted cost of capital is determined by solving first the proportion of each source in relation to the total equity of the business. So the results are then multiplied by the individual cost. The sum of this process equals the weighted cost of capital. So the formula is just the same. We are going to use all the given formula that we had. So we have the cost of debt, the cost of ordinary shares, and then also the cost of, okay, that's it. And then here, so the proportion of individual items of the capital structure is next determined as follows. So that ends our lesson for today for our first quarter. So congratulations everyone, you already already ended our first quarter lesson. So that could be all for today, and thank you and goodbye.